Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, so we're diving deep into capital allocation today.
Ooh, capital allocation.
Yeah,
Sounds exciting.
how companies make those big money decisions where they choose to invest their resources for, maximum impact.
That's right. That's right. And we're going beyond the textbook definitions.
Yeah.
We want to give you
You want the real world.
real world examples. Exactly.
Yeah, we got fascinating case studies lined up from tech giants to, legendary investors.
Absolutely.
So before we jump into the case studies, I think a quick level set is in order.
Okay.
When we say capital allocation, what are we actually talking about?
At its core, capital allocation is about choosing where to deploy a company's financial resources. You can think of it as like a company's financial roadmap guiding their investments for growth and value creation. So it's not just simply spending money.
Right.
It's about making strategic choices that align with their long-term goals.
Got it. So it's not just about picking the, flashiest project or the one with the biggest potential payout. There's a real strategic element here.
Absolutely. And to make those strategic choices, companies rely on a set of key metrics. Okay. These aren't just like abstract numbers. They're tools that help assess the financial viability of different investment options. For example, return on investment or ROI measures the profitability of an investment relative to its cost. It helps companies compare different projects and prioritize those with the highest potential returns.
So ROI is like a quick snapshot of how efficiently a company is using its money.
Exactly.
What are some other metrics that they consider?
Another crucial metric is net present value, or NPV.
Okay.
It takes into account the time value of money, recognizing that a dollar today is worth more than a dollar in the future. So NPV calculates the present value of future cash flows generated by an investment discounted back to today's dollars.
So NPV helps determine if an investment is actually adding value to the company, considering the time it takes for those returns to materialize.
Right.
Sounds like these metrics are all about making informed, data-driven decisions.
Precisely. And then you have the internal rate of return, or IRR, which is the discount rate that makes the NPV of an investment equal to zero.
Okay.
Essentially, the expected annual rate of return for a project.
Okay, starting to see how all these metrics kind of fit together.
Yeah.
So they use these tools to compare different options, like investing in, new product development versus acquiring another company.
Exactly. And within those broader choices, there are even more specific options to consider.
Okay.
Do they reinvest profits back into the business, maybe expand operations or develop new technology, or do they reward shareholders through dividends or stock buybacks?
So many options.
So many options, yeah.
It sounds like there's no one-size-fits-all approach each company has to tailor its strategy to its own, unique circumstances.
Right. Let's dive into a real-world example to illustrate this. Think about Amazon.
Okay.
Back in the early 2000s, they made a massive, and some would say risky bet on a then nascent technology, cloud computing.
You're talking about Amazon Web Services, right?
AWS?
AWS. I mean, now
Right.
it's this
Huge.
massive multi-billion-dollar business.
Yeah.
But back then, it was a completely unproven concept. What made them take that leap?
Well, Amazon recognized the potential of cloud computing to disrupt the traditional IT infrastructure market. They saw an opportunity to leverage their expertise in e-commerce and data management to create a scalable, on-demand computing platform.
Right.
But it was a huge gamble,
Yeah.
requiring billions in upfront investment with no guarantee of success.
So they had this vision of a future powered by the cloud, and they were willing to put their money where their mouth was, even if it meant taking a big risk.
Exactly.
And I guess it's safe to say that gamble paid off in a big way.
It did. It did.
AWS now generates a significant portion of Amazon's overall profits.
It's a textbook example of how a bold, long-term reinvestment strategy can lead to exponential growth. But not every company has the appetite or the resources for that kind of aggressive reinvestment.
So what about companies that generate tons of cash but maybe don't have those groundbreaking new ventures to invest in? What do they do with all that money?
That's where strategies like dividends and share buybacks come into play.
Okay.
Take Apple, for instance. They're known for generating massive cash flows, but instead of pouring all those profits back into internal R&D or expansion, they've chosen to return a significant portion of that cash to their shareholders.
You're talking about their massive stock buyback program, right? I
Exactly.
remember reading that they've spent hundreds of billions of dollars buying back their own shares over the past few years.
That's right. And by reducing the number of outstanding shares, they effectively increase earnings per share, which can boost the stock price and make shareholders happy.
Right.
It's a way to reward investors when a company believes its own stock is undervalued or when it has more cash than it can effectively reinvest.
So two very different approaches to capital allocation.
Right.
Amazon with its bold long-term bets and Apple with its focus on returning value to shareholders. It's fascinating to see how these choices reflect each company's priorities and vision.
And we've only just scratched the surface. We've got a lineup of other fascinating case studies to explore, each highlighting a different aspect of capital allocation, from Warren Buffett's legendary acquisition strategy at Berkshire Hathaway to Microsoft's strategic shift towards cloud computing. We'll uncover the decision-making processes behind some of the most successful companies in the world.
All right, I'm ready for more, but before we move on, I want to check in with you, the listener. Are you seeing any parallels between these big picture strategies and the decisions being made at your own company?
It's a great question to consider. Whether you're working in a large corporation or a small startup, understanding capital allocation can give you valuable insights into the financial health and future prospects of any organization. Keep those principles of ROI, NPV, and IRR in mind as you analyze companies and make your own investment decisions.
Yeah, and don't be afraid to ask those tough questions.
Sure.
Challenge those assumptions and really dig deep into the numbers because ultimately capital allocation is about making smart choices that drive long-term value.
Let's shift gears now and talk about a company that's mastered the art of strategic acquisitions. Berkshire Hathaway, Warren Buffett, the legendary investor behind Berkshire, has built an empire by acquiring undervalued businesses with strong fundamentals.
Yeah, Buffett's known for his long-term approach and his ability to spot hidden value where others might miss it, but acquiring a whole company, that's a pretty major capital allocation decision, right? Not your average investment.
Absolutely. Acquisitions can be a powerful way for companies to expand their market reach, acquire new technologies, or simply eliminate competition, but they can also be risky if not approached carefully. One of Buffett's most successful acquisitions was BNSF Railway back in 2010.
So he bought a whole railroad company. I mean, that seems like a pretty old school industry. What was the strategy there?
Buffett recognized that rail transportation is a critical part of the U.S. economy, especially for moving goods across long distances. He saw BNSF as a well-managed company with a strong competitive position and a wide network of rail lines. And as the economy grew, so did demand for rail transportation, making it a very profitable investment for Berkshire.
So he was betting on the long-term growth of the U.S. economy and the essential role of rail transportation within that kind of a classic Buffett move, right? Thinking decades ahead.
Exactly. But acquisitions aren't always about buying established players in traditional industries. Sometimes it's about tapping into emerging trends and acquiring companies that are disrupting the status quo.
Okay, I see where you're going with this. Let's
Yeah.
talk about Microsoft. They were the kings of traditional software, but then the whole tech landscape started shifting towards cloud computing.
Right. And to their credit, Microsoft recognized this shift early on and made a bold decision to pivot their capital allocation strategy. They invested heavily in building out their Azure cloud computing platform, even though it meant cannibalizing their own legacy software business to some extent.
So they were willing to disrupt themselves to stay ahead of the curve that takes guts. And it seems to have paid off. Azure's now one of the leading cloud platforms right up there with AWS.
Absolutely. It's a prime example of how a well-timed and well-executed capital allocation strategy can transform a company's trajectory. They could have easily clung to their existing software dominance, but they chose to embrace the future and allocate resources accordingly.
It makes you wonder, are there any companies out there right now making similar bets on emerging technologies that could reshape their industries in the years to come? What are some of the big trends that you think will drive capital allocation decisions in the near future?
That's the billion-dollar question. Artificial intelligence, AI, renewable energy, and personalized medicine are just a few areas attracting significant investments. It'll be interesting to see which companies make the right bets and emerge as leaders in these emerging fields.
It's like a giant game of chess, right? Trying to anticipate the next move, allocate resources strategically, and position yourself for success in a constantly evolving landscape.
It's exactly. And speaking of companies that have made big bets on emerging trends, let's talk about Netflix. They completely revolutionized how we consume entertainment by shifting from licensed content to original programming.
Yeah, remember when Netflix was just a DVD rental service? Who would have thought they'd become this global entertainment powerhouse?
Their decision to invest billions in creating their own original content was a huge gamble, but it paid off spectacularly. They recognized that consumers were craving high-quality on-demand entertainment, and they were willing to take the risk to meet that demand.
And now they've got hit shows that everyone's talking about, racking up awards and attracting millions of subscribers worldwide. It's amazing how a well-placed bet on content creation can reshape an entire industry.
It's a testament to the power of a focused capital allocation strategy. They weren't afraid to disrupt the traditional television model and invest heavily in something new and unproven.
Speaking of big bets in the entertainment industry, Disney's been making some major moves as well. They've got their theme parks, their blockbuster films, and now their streaming service, Disney Plus.
Disney is an interesting case study because they have to balance capital allocation across multiple entertainment platforms. They've had to make tough decisions about where to invest their resources, especially with the rise of streaming, challenging the traditional movie theater model.
Yeah, it's like they're juggling multiple giant piggy banks at once, and with so much competition in the streaming space that those decisions are even more critical.
In recent years, they've shifted their strategy to prioritize streaming growth, even if it means scaling back on some of their traditional investments. It's a recognition that consumer habits are changing, and they need to adapt to stay relevant.
It's a reminder that even the most established companies need to be willing to evolve and adjust their capital allocation strategies to navigate the ever-changing business landscape. It's all about staying ahead of the curve and anticipating where the puck is going, as Wayne Gretzky famously said.
Now let's move on to a company that's been making headlines for its massive investments in U.S. manufacturing. Intel. They've pledged billions of dollars to build new chip fabrication plants, a major shift from their previous reliance on overseas production.
I've been following that story. It seems like a combination of factors is driving this decision, a desire to bring manufacturing jobs back to the U.S., concerns about supply chain vulnerabilities, and maybe even some good old-fashioned patriotism.
You hit the nail on the head. It's a complex decision driven by a mix of economic, geopolitical, and even social considerations.
So it's not just about maximizing ROI in the short term. There are these broader strategic factors at play as well. It's like they're playing 3D chess.
Precisely. Intel's betting on the long-term benefits of having more control over their supply chain and contributing to the growth of the domestic semiconductor industry. It's a strategic move that goes beyond pure financial calculations.
It's a great reminder that capital allocation isn't just about crunching numbers. It's about understanding the broader context of the competitive landscape and the long-term implications of your decisions.
And speaking of long-term implications, let's talk about a company that's made significant investments in the future of healthcare, Pfizer.
Pfizer's always been a major player in the pharmaceutical industry, but they've been particularly active in recent years with acquisitions and strategic partnerships.
That's right. They've been focusing on high-growth areas like oncology and gene therapy, making strategic acquisitions to bolster their research and development capabilities.
Like their recent acquisition of Seagen, right? That was a multi-billion-dollar deal. What was the thinking behind that move?
Seagen is a leader in antibody drug, conjugates a promising new class of cancer therapies by acquiring them. Pfizer gains access to their cutting-edge technology and a pipeline of potential blockbuster drugs. It's a classic example of using acquisitions to accelerate growth and stay ahead in a rapidly evolving industry.
So it's not just about buying any company, it's about finding the right strategic fit, a company that complements your existing strengths and fills gaps in your portfolio.
Exactly. Pfizer's capital allocation strategy reflects their commitment to innovation and their belief that these new therapies represent the future of cancer treatment.
It's incredible how diverse these approaches to capital allocation can be, from betting on railroads to disrupting entertainment to pushing the boundaries of medicine. Every company has its own unique story to tell. But before we jump into our final part, I want to ask you, the listener, a question.
I love a good thought-provoking question. What do you have for our audience today?
As you've been listening to these case studies, has anything surprised you? Have you gained any new insights that you can apply to your own work or investments? We'd love to hear your thoughts.
Okay, so we've covered a lot of ground in this deep dive, exploring how companies like Amazon, Apple, Berkshire Hathaway, Microsoft, Netflix, Disney, Intel, and Pfizer have made those strategic decisions to allocate their capital.
Yeah, we've seen how they've invested in new technologies, made strategic acquisitions, returned value to shareholders, and just adapted to changing market dynamics.
But let's shift gears now and bring it back to you, the listener.
Because understanding capital allocation isn't just about analyzing big companies from afar. It's about applying these principles to your own career and investments.
Absolutely. Whether you're working your way up the corporate ladder, managing your own portfolio, or simply trying to make sense of the business world, these concepts can be incredibly valuable.
So let's say you're like an FP&A analyst tasked with, evaluating a potential investment for your company. What are some key questions you should be asking? What are those red flags that might make you hesitate?
Well, first and foremost, you need to understand the company's overall capital allocation strategy. Like, what are their priorities?
Okay.
Are they focused on growth, profitability, or striking a balance between the two?
Right.
This will give you context for how they approach different projects and make investment decisions.
Okay, so you're looking for alignment between the proposed investment and the company's, bigger picture goals make sense. What else?
Then you want to dig into the financial projections. Don't just take the numbers at face value. Question the assumptions behind them. Is the revenue growth realistic given the market conditions? Are the cost estimates accurate, or are there potential hidden expenses?
It's like being a financial detective, right? You're looking for clues that might reveal, hidden risks or opportunities.
Exactly. And don't forget about the all-important return on investment. Is this project going to generate a sufficient return to justify the capital outlay? Remember those metrics we discussed earlier, ROI, NPV, IRR?
Those are your trusty sidekicks in the world of capital allocation. They help you cut through the noise and make objective decisions.
Exactly.
Now let's flip the script and imagine you're an investor looking to put your money to work in the stock market. How can understanding capital allocation help you choose winning companies?
Well, when you're researching a company, pay close attention to their track record of capital allocation. Have they consistently made smart decisions that have generated strong returns for investors? Or have they squandered their capital on ill-advised acquisitions or projects that went nowhere?
It's like checking a company's credit score before lending them money, right? You want to see if they're responsible with their finances.
That's a great analogy. Look,
Yeah.
for companies that have a clear and disciplined approach to capital allocation, do they prioritize reinvesting in their business to fuel future growth? Do they have a history of making shareholder-friendly moves like dividends or buybacks?
And if a company's constantly changing their strategy or making impulsive decisions, that might be a red flag, right? Like they're not really sure what they're doing.
Absolutely. Consistency and discipline are key in the world of capital allocation.
So to sum it all up, whether you're a seasoned finance professional or just starting out on your investment journey, understanding capital allocation is essential for making informed decisions and navigating the complexities of the business world.
It's a fundamental principle that can help you analyze companies, evaluate investment opportunities, and ultimately achieve your financial goals.
And as we wrap up this deep dive, I want to leave you with one final thought. When you're analyzing a company, don't just focus on the numbers, consider their capital allocation strategy. It reveals a lot about their long-term vision, their priorities, and their commitment to creating value for their stakeholders.
It's like peering into the engine room of a ship. You can see how all the parts work together to propel the company forward.
Exactly. And with that, we'll conclude this deep dive into the fascinating world of capital allocation. We hope you've gained some valuable insights and feel equipped to apply these concepts to your own financial endeavors.
Until next time. Stay curious, keep learning, and may all your capital allocation decisions be wise ones.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.